We are diving into the national portion of the life insurance exam, focusing specifically on the taxation of non-qualified annuities, which is a high-frequency topic that often trips up candidates because the rules change depending on how the money is taken out. When you see the term non-qualified on your exam, you should immediately think after-tax dollars, meaning the principal you put into the annuity has already been taxed and will not be taxed again upon withdrawal, but the growth is tax-deferred and will be taxed as ordinary income. The big distinction examiners love to test is the difference between random withdrawals made during the accumulation phase and periodic payments made during the liquidation or annuitization phase. For random withdrawals before you officially annuitize the contract, the IRS uses the last-in, first-out method, or LIFO. This means the very first dollars you pull out of the account are considered to be the interest and earnings, which are fully taxable as ordinary income. Only after you have withdrawn every single cent of growth do you get to touch your tax-free cost basis. An exam question might describe a client who invested $50,000 that grew to $70,000 and then decided to withdraw $10,000. The trap here is thinking the $10,000 is prorated or tax-free because it's part of the original investment. But under LIFO, that entire $10,000 is taxable because it comes out of the $20,000 of growth first. This is a classic trick wording scenario where the exam focuses on the source of the funds. Now, everything changes once the contract owner chooses to annuitize, which is the process of converting the cash value into a guaranteed stream of income. At this point, LIFO is thrown out the window and replaced by the exclusion ratio. The exclusion ratio is a formula that determines what percentage of each monthly check is a tax-free return of your principal and what portion is taxable interest. You can remember this with the phrase, principal is protected, because the exclusion ratio protects your original investment from being taxed twice. On the exam, you might be asked what happens once the entire cost basis has been recovered through these payments. The answer is that the entire payment becomes fully taxable once the principal is gone. Another critical area for the national exam is the premature distribution penalty. If a contract owner takes a withdrawal before reaching age 59 and a half, they are generally hit with a 10% tax penalty on the taxable portion of the withdrawal, in addition to regular income tax. A common mistake is thinking the penalty applies to the entire withdrawal amount, but it only applies to the earnings. A mnemonic to help you keep these two phases straight is LIFO for the flow and ratio for the show. Use LIFO when money flows out randomly and the exclusion ratio when the lifetime income show begins. Examiners will also try to confuse non-qualified annuities with qualified plans like a 401k or a traditional IRA. Remember that in a qualified plan, the entire withdrawal is typically taxable because the money went in pre-tax, whereas in the non-qualified annuities we are discussing today, only the growth is taxable because the principal was already taxed. If you see a question about a corporate-owned annuity, remember that these generally do not receive tax-deferred growth at all, which is another nuanced point often hidden in the distractors. Focus on whether the policy is being cashed out or turned into a stream of payments, as that determines whether you apply LIFO or the ratio, and always look for the age of the owner to see if that 10% penalty applies.